Good morning, everybody. Welcome to the new week. Welcome to the Flow Show. Morning, Stel.
Good morning, mate. How are you?
All good, mate. Had a good weekend?
Very good.
Good, good. Out to much?
Yeah, all good, all good. Looking forward to being in London in a few days' time.
Yeah, we're getting the weather ready for you, mate.
Apparently, it's going to get colder, but it doesn't matter. As long as it's not raining, cats and dogs, I'm fine with that.
No, it's been raining sheep and pigs here recently, so I don't mind cats and dogs.
How was
But
your
yeah,
weekend?
yeah, it's all good, mate. Bit of a quiet one. Stayed pretty much around the house doing a few bits and bobs. It was a wife's birthday, the
Oh,
brother-in-law's birthday,
nice.
so out Saturday night for a meal. Yeah, very nice, very nice.
Excellent,
Taking it
excellent.
easy. And yeah, we should remind people you're over in London, 7th of February, because we're also having a bit of a get together because we didn't manage to do one over Christmas, trains being on strike and whatnot. So there's a few of us meeting up on the 7th. Stel's over as well, obviously, in London. So if you're feeling like you want to pop up to the town, to the smoke, to meet us for a drink, then please feel free. I'll put some details out on Twitter or wherever in the chat room when we got a final destination and
Yeah,
times.
should be
7th of
should be
February.
should be somewhere in the city of London, I guess. In the city in the center. So,
Yeah, we'll
but
find a suitable
yeah.
establishment. We're not short of them, but that's an open invite for anyone who's in the UK near London, wants to come for a drink, have a meet up. You're more than welcome. Look out for details. Tickets are only £5 each. No, I'm joking. Right, let's get stuck into it. Over in good old China, they're properly opened up now after the New Year's holiday. The central bank, PBOC, is said to be rolling over some of its lending tools to help spur growth, according to sources speaking to Reuters. Separately, the Ministry of Finance was out this morning to say it will pursue targeted tax cuts to aid the economy this year. Other news from China is that apparently it was a pretty good holiday on the economic front. Lots of spending, lots of people out and about. COVID seemingly being pushed into the rearview mirror. So we likely to see some better economic numbers maybe coming in over the next couple of months at least, as China sort of stages a COVID bounce like we saw in other countries after coming
Yeah,
out of lockdown and stuff.
Ryan, I don't know how it was over there, but here in Athens, when the lockdowns were lifted and when things were back to normal, I mean the amount of people on the streets and the shops, and I remember going, trying to book a restaurant, and it's like, yeah, it's been booked for now for like a month. So
Yeah,
it was everybody just going out because of pretty much 2 years of constraints. You couldn't
yeah,
go out, you couldn't do stuff. So I'm guessing the Chinese are going to be also roaring to go out and do stuff and spend.
yeah. So naturally, we're going to likely see an economic bounce, though how long it lasts remains to be seen. But it could be hard and sharp. Yeah, it was pretty similar over here. I remember the first time we came out of lockdown. I think it was a Wednesday. And we thought, okay, it's the first day out of lockdown. Shouldn't be too busy down the beach. We'll go down the beach after school and whatever. Got down here, it's absolutely ramo. I mean, literally, everyone must have just exited every inside town, inland town, and hit the beach. I mean, there were people there from Newcastle, from Manchester. It
Wow.
was. We nearly turned around and walked back because it's never that busy in the summer. It was unbelievable, but yeah, and pretty much the same after we came out the second lockdown. So
Yeah.
yeah, we should expect that from China, but we'll see how whether it lasts or not. Moving over to Japan, and Kuroda was out overnight saying that it's possible to hit stable inflation with continued easing. Go figure that one out. And they must continue the easy policy to maintain the 2% inflation target. Now, there's more noises coming out of various different areas regarding what the Bank of Japan should do when Kuroda leaves the helm. There's a Japanese productivity center panel who last really spoke in 2013 when they had their idea of what the Bank of Japan should do. And this time the panel says the government and the BOJ are urged to set a 2% inflation target as a long-term goal. So pushing the boundaries, if you like, kicking the can a bit further as to when you get to 2%, a bit like what the Fed did with its AIT that they never speak about anymore, their average inflation targeting. That went out the window once inflation hit about 4% and carried on going up to 9%. Remember that AIT still?
That was ridiculous, and we were talking about it when they introduced it, and it's like, yeah, you know, where I don't understand, but anyway, you know, anything they can do to help themselves stay dovish for longer and keep rates lower than they otherwise could. But
yeah, they made a big song and dance of it, the AIT, and you haven't heard a peep from it since. Someone should bring that up at the FOMC press. Oh, hey, pal, what happened to your AIT? Oh, yeah, remember that? Crazy. So anyway, that was the Japan Productivity Center panel saying that they should make the 2% target more of a long-term goal. Another one, the Japanese Research Institute chairman Akina said, and this guy, okay, I'm not sure what he is apparently in the running for contention to be the new, well, a deputy governor at the Bank of Japan, I think it is, rather than the governor. They said they need to overhaul various aspects of monetary policy, and there needs to be a rethink of BOJ government cooperation. So a lot of noise continues to grow around the Bank of Japan, what they should do in monetary policy, who's going to take over, how the government should interact with them. This is all going to obviously come to a head at the end of this quarter, if not sooner, once we know who's going to take the hot seat and what the government and the Bank of Japan are going to do about their framework moving forward. So lots to come in on that one. Right, coming over to Germany, and fortunately no speaking heads from the ECB there. Oh, it's lovely and quiet. We love it when it's nice and quiet. But GDP from Germany this morning came out a little worse than expected, down 0.2% quarter on quarter versus flat expected on a prior of 0.4%. So we knew it was going to be there or thereabouts. There's been enough German officials coming out saying they expected growth in the fourth quarter not to be that inspiring. We also got economic sentiment from the Eurozone. Bit more of an improvement there. Economic sentiment overall 99.9. Let's get the calendar up so you know what I'm talking about. Economic sentiment 99.9. Where is it gone? I've lost it. Where is it? It's not there. Oh, there it is, there, nice and green. 99.9 versus 97 expected, so a decent rise there. The consumer inflation expectations and selling price expectations, though, they dipped back quite a bit. 17.7 versus 23.2 prior, and selling price expectations, that's firms expecting to where they expect prices to be, down a bit as well there. That's something the ECB will be looking at because inflation expectations are a big part of their mandate. So a bit of softness coming in there. Unlikely to change thoughts about what the ECB do this week in terms of hike size. We are apparently on a predetermined path. But if we continue to get those numbers going south further, that may put a bit of dovishness into the thinking now. And speaking of inflation, obviously last week, the PCE data from the US, numbers came in round about as expected on both measures, both the core and the headline. As you can see there, headline came in to, oh, where are we looking at? That's not right. Was it expected 5.5? I think that's around the wrong way. They were coming in actually expected. Yeah, core came in at 4.4%. Yeah. I don't think that expectation was right. I think it was expected to come in at 5%, and it came in bang in line at 5%. So there wasn't much to take from those numbers there. What is a little take from it, if you're going to be picky, perhaps, is the spending and income numbers. Income came in as expectation, but spending a little worse than expecting, and real adjusted spending down worse than last month, minus 0.3% there. Not entirely surprising considering what we saw from November and December retail sales. But these numbers perhaps are going to need monitoring, maybe more so than the PCE numbers, because if income starts dropping and spending drops further, it's going to add some increased worries for the consumer there, and that's something the Fed will be keeping an eye on. In the Michigan, again, it's more about the inflation numbers. Although the headlines sentiment was up a bit, but the final reading showed that we got a pop to 3% in the flash number, and it went back down to 2.9%. Also in the longer term fund inflation expectation, 3.9% there versus 4%. So again, a little bit softer. Sorry, that's on the 1 year. So those numbers there, again, expectations from the US consumer, perhaps seeing past the height of expected price rises, and things are starting to edge down as far as they're concerned. Obviously, these numbers can be influenced a lot by what gas prices are, fuel prices, petrol prices are. They are a big part of the US consumer inflation mindset, if you like. When gas prices are high, the world is ending. When they're lower, everything's rosy, and those have been coming down. So after all that data, for the Fed at least, Fed funds futures continue to price 25 pip hike for this week, plus one more 25 pip hike before stopping. So the Fed, according to these guys and girls, are going to go a total of 50 BPs on their next two outings, one obviously this week. That would take the rate roughly up to 5%. Just under 5% actually, because we're midpoint 4.375. So take it round about that 5% mark, which is a little bit lower than what the Fed have been telling us they want to get rates to, and those dots. So that's going to be an important feature when we get this meeting this week. Obviously, lots to talk about regarding that. Now, there's some news from the WSJ, and our mate Timmy Leaks, Nick Timiraos at the WSJ, saying that the Fed might be debating whether wages or low employment will drive inflation. This is him talking about the fact that the jobs market has been strong, wages are still rising. Is that going to bring a second round of inflation? And is it something that the Fed are going to be concerned about, and obviously reflect that in their monetary policy? This is all going to feed into whatever we get from the FOMC, Powell, and the presser, and how they see things moving forward. We are still looking at some key things like financial conditions. Obviously, the jobs market has been strong. The data has been a little softer elsewhere. So how the Fed is going to play this going into Wednesday is going to be a bit of an open book. I think the market, if it's thinking a 25 and a 25 and that's it, I don't know. I think that's maybe a little too much on the dovish side. What do you think, Stel?
For the Fed and the expectations, you mean?
Yeah, for the Fed.
I was just looking at the Fed fund futures curve, and you're right. You know, we're expecting 25 this week and another 25. But the question is that the Fed members, like you correctly said, they've been telling us, and Powell's been telling us that and the dot plot shows slightly higher. I'm not sure. I will wait to see the pace of the drop on the year-on-year CPI this month, and I think that's going to be crucial because I've talked about it for ages and ages, the change in calculation, etc. I think the drop is going to be fast, and I think that's going to give the Fed enough reason to stop after the next, this week, and then one more. I think they're going to stop, and we have to also remember the core PC. Sorry, not the core PC. Yeah, the core PCE, their favorite measure. once they hike, is then going to be inflation. The core PCE is going to be below the Fed funds rate. So that's what they want. They want positive real rates. Now, obviously, compared to the CPI year on year, which is not their preferred measure, but this is what most people look at, it's still going to be there or thereabouts. But core PCE is already going to be below once they hike now. So what do I think about what the market's pricing? I think it's fair. I think what we're going to get is we're going to get 25 this week. And the narrative is not really going to change much. It's going to be relatively, I don't want to say soft, but I don't think it's going to be hawkish. And I've explained this. Sorry?
Fence sitting a bit?
Fence sitting a bit, yes. I bet you they want to see the CPI number this month as well, so I'm guessing there's not going to be much change to the language. There's no reason for it to be. And you talked about employment. Yes, employment is still showing pretty good numbers now. There's some controversy about the non-farm payrolls, which, by the way, we get this week again. And there are two surveys, right? The BLS number, and there's another one which is the households number. I can't remember how it's called. And there's a discrepancy of over 1 million jobs on that. And obviously the BLS number is higher. And we are seeing already revisions to the numbers, the BLS numbers. And so we have to keep an eye out on that, because they show the really strong numbers. And then the next month and the month after, they start revising lower. So we have to obviously keep an eye on that. But overall, employment is still the only thing going well for the economy overall. Yes, we do have the odd good number here and there, but really PMIs and all the rest, they're not looking that great. And you did also mention wage growth. That's still ongoing, but it's well below inflation. It has been for the past months. Yes, we have wage growth in 4 or 5%. And that will definitely be a reason and a cause for a second round inflation coming through. But again, I'm cautious. I think that this month's inflation number, or February's inflation number, is going to be low, and it's going to be potentially considerably lower than expectations. Let's see if I'm right or not. But I am a little bit worried, and I think the Fed are also waiting for that, and I think the market's trying to catch on to that slowly, and that's, I think, what we're seeing, this little squeeze. Yes, we're down today, but we are overall kind of slowly squeezing towards the FOMC this week. And I said before, I think we're going to get to, there's a good chance we're going to get to 4,100, maybe even 4,150 in the S&P before the FOMC. Well, on Friday, I think we touched 4,100 or thereabouts, almost 4,090 something. So it is quite squeezy going into it. Shorts getting squeezed, and I don't have great conviction either way, but I definitely wouldn't want to be short risk going into the Fed. I know people are talking about, they're going to surprise, they're going to be hawkish again and again. Yes, they are slightly on the hawkish side. They have been, but if you notice, they're also taking a little step back, and they're kind of softening as we go forward. So I'm not convinced either way. That's a problem I have.
Yeah, definitely. And that S&P, I mean, we were talking about it last week, that if it, shaking out the people trading against that trend line up against the 4,000, we said if it got a hold above that trend line above 4,000, it was going to have perhaps a move up to 41, and it got close enough. But I think likely we're going to see just maybe a bit of short-term range play this week, because we've got a ton of data out. Obviously got the big central banks. I had to shrink this screen to try and fit it all in. It's a huge data slate this week, coming right amid all the central banks as well. We've got CPI numbers, we've got GDP numbers, house data, we've got the main US consumer confidence tomorrow. It's jobs week. ADP starts on Wednesday. ISM, JOLTS, obviously the FOMC Thursday. We got Bank of England, ECB, jobless claims, factory orders, and then obviously finishing on the Friday, final PMI numbers, services ISM, and obviously the NFP data. So it's a big old way.
It's packed. It is packed.
Get the coffee on now, because you're going to need to be wide awake for this one, folks. So not going to get into it too much today. Today is probably the quietest day we're going to get, so it's all about getting prepped, getting ready. Tomorrow, all being well, we're going to have a chat about trading the crosses, as mentioned last week, just taking a little bit of a turn off what we usually do after the headlines, just to talk about the crosses and how they can be beneficial. You don't have to always trade everything versus the dollar. There's plenty of opportunities in the crosses to keep yourself out of the dollar side of things. And that was one of the subjects for a piece I wrote at the beginning of the year on the blog. Crosses, I think, are going to be big players in the divergence trade between central banks this year, and it's already proving the case in some pairs. So lots to look at this week on the data front, and as I say, we'll have a look at the cross situation tomorrow. Kyle will be back tomorrow. He's playing dad's cabs again today, doing airport runs and whatnot. So how are we coming into today? Really, this week around these events, what I think is going to happen is, we're going to get the data out, and it's quite big data, and the market's going to move. It's going to make its last minute adjustments for expectations for the Fed based on this data, that data, and whatever. But as we saw last week, the market's willing to move, but it's not willing to push itself outside of the well-worn boundaries that we're in at the moment. And I think that theme is going to continue. We had some data. We couldn't take out the highs in the euro dollar. We couldn't break above this 109.40 I've been watching for God knows how long. We also couldn't break out the downside, get down to 108.30 or 108, the figure. So a lot of pairs are showing this type of price action at the moment. Cable's having another look up towards the highs. Can it go? Will it not? If you start to see these moves happening at this stage before big central banks, if it can't take out new highs, significantly, or take out the lows, get below 123, that sort of thing, then you're setting up your range for this week until we get those events and know finally what the central banks are going to do. So for me, it's just going to be about maybe sniping around the ranges. Sometimes in big weeks like this, I tend to trade less just because there's so much risk there, and we're obviously waiting for these big events to happen. So the most I may do is, as I say, snipe a few bits and pieces or sit on my hands and just manage what I've got. One of those is Aussie dollar, which you boys and girls will know I've been long since last year. It's playing nicely with the tech again. It's set its range up towards this high band here, this zone up here. It's not getting through that. Conversely, it's not getting back under this 70.65 level significantly. So a decent enough area to play around in. I wouldn't mess around in the middle here. If you're a scalper, maybe you can lean on 71 for a short, that sort of thing. Grab yourself a few pips off of that. But for me, I'm continuing to be long. My last entry long was in here, actually off this level, when we had this move down here. I've knocked some off, so I'm still a bit long here. I'm looking to fold it into my core long, but that is going to mean I need to see a break above this 40 zone to move on up before we tackle the next zone, which is just above. If we do move under here, I still think there might be a bit of scope to see us down to the low 70s, maybe even the big figure, just on a few players who might be thrown in the towel because we haven't managed to break up. If we break back down below this level, they might throw in the towel and we see a move further down. So that's a couple of pairs I'm looking at. One of them obviously trading. Dollar yen is another we're looking at closely. It's up and down. It doesn't, this is typical sideways action from dollar yen. We're either 129s or we're 130s or we're messing around in between. So again, watch the data. Look for the edges down to these 127s, up to these 131s. The bigger numbers come in, 133s, then up to the 134s, 34s and a half. So this one, as we've been saying all last week, not doing anything at all. I've got no interest whatsoever messing around in here. If you're scalping it top to bottom, good luck to you. I hope you make many pips of it. But for me, I'm going to be seeing what happens with this over the Fed, whether it's going to take us to new ground or just test the edges of the range, and the market's happy with its pricing for now. Also, bond yields. I don't expect these to do much as well. You know, we look at these, and I've been paying a bit more attention to this 1 year yield at the moment, just coming into the FOMC, because we're in January, so it is a bit of reflective of you know, where the market sees rates over this year entirely. And as you can see, it's still not flagging that we're going to get up to 5%. And in the 2 years, even more so, you know, holding underneath 4.25 now. And, you know, the market, this tells me that the market is leaning very unhawkish going into the Fed. So the question for me, the key question for me, is it right? Or is the Fed going to stamp on it and say, you're too dovish on this, you need to get your expectations up a bit? What do you make for yields, Stel? You know, if they go with 25, can you see even yields keeping up in 4%?
What do you mean if they go 25? They will go 25. There's no way they're going to do 50 or nothing, right? But
well, I think they probably will go 25, but I think there might be a risk they go 50. But that's just me. But even so, if we got 2 and done, that puts us at 4.5%. But the market's not even really pricing, you know, 4.5%, 5% at the moment.
You're talking about, you're looking at the 1 year or the 2 year?
Yeah, look at the 1 year. Either,
yeah.
You know.
Yeah. It's a tough one. We are getting to, as we're getting to the end of the cycle, it's becoming a bit more binary now where they're going to stop. So I remember when I was trading interest rate swaps, I traded the short end, so 0 to 2 years primarily, although I did have positions up to like 30 years in other stuff. But really 0 to 2 years was the part that I was a market maker. And this, when you get to this part of the cycle, things can really change, because, you know, when you get to the point where they do 25 now and they maybe do one more or no more or two more, it makes a big difference on the 6 month and the 1 year rate, right? Obviously. So we're getting to the point where the market has decided now that 125 this month and another 25 next meeting is what's going to be done. So you know, given those two 25s, I think, you know, and look at it, it's going sideways, right, for the last few months. So the market's kind of the market's happy with this projection, and this is what is expecting. So I think given those two, the market is, you know, the 1 year is, and maybe the 2 year as well, are trading within reason. Now the thing that is a more difficult one is a 10 year, because that's trying to predict what's going to happen for the next 10 years instead of just the one. And we are clearly seeing the market expecting cuts, and substantial cuts as well. So that for me is a tricky one, because I think we're already pricing. I've said this before. We're pricing quite a bit, you know, in terms of cuts and in terms of how quickly they're going to come. So it's a really difficult one. I think personally, even with the Fed stopping after the next 225, so let's say they hike 25 this time and they say, yeah, well, maybe one more, they give this forward guidance and then we're done. I still think the risk is for 10-year yields to go higher. Simply because I think that even though inflation is going to start dropping this year, and I think it's going to continue to drop, and it's already dropped, it's going to continue to drop fast. I think after a while, it's going to start creeping higher again, because these price pressures are going to stay elevated. Now, I've talked about this year-on-year change, which everybody looks at. I think that's going to drop quite quickly, and it's going to continue dropping, but then it's going to start gradually rising. And I think that's what's going to make the Fed less happy with cutting rates. That's what I think. I think cutting rates is not going to come as quickly as the market expects. So for me, the 10-year, the risk for the 10-year is for yields to go higher. And And that's how I'm going to play it. So if I do see yields dropping, obviously, unless the Fed goes ultra dovish, if that happens, then okay, all bets are off. But if the Fed's message continues unchanged and it's kind of roughly what the market's expecting in terms of monetary policy, I think then the risk is going to be for yields to go higher, 10-year yields to go higher, and that's what I'm going to play. So I'm going to wait for maybe a pullback in yields toward those lows, 340s ish, and I'm gonna try shorting 10-year, because again, where you're wrong.
Yeah.
It's for me, it's a relatively simple trade. It could go wrong, but it could go wrong very simply.
I like those ones. Yes, I like when it goes wrong simply, rather than complicated. Now, just a quick look at the probabilities for the big banks this week. So obviously, the Fed there, high probability of a 25 pip hike, still pricing a 50 pip hike, just about. It'll be interesting to see how we finish the Fed and whether we start pricing 25s and unchanged after the Fed. The ECB, there's still quite a significant amount probability going into a 75 pip hike there, even though the guard has pretty much told us it's going to be a 50. So you can never take this as gospel pricing. It's probabilities derived from different market measures, so it's not a direct comparison. But I would have thought that probability might have been a bit higher for the 50, sort of same lines as the Fed. And then you can see for the Bank of England, 81% probability of a 0.5% hike versus 25 pips, the balance there. And the Bank of England also expected to hike by 50 and then turn to 25s thereafter, and maybe indicate when they're going to pause. I think out of all the three central banks we've got there, I think the biggest, the ones with the biggest risk is the Fed, as we said, of maybe being a bit more hawkish than the market expects. I think the ECB is going to be a bit of a dud because we know what we're getting. I doubt anything's changed in terms of getting a 50 and getting another 50. So it might be a bit of a dud event. What did strike me last week, as mentioned, is that we got pretty much every ECB member out speaking last week, all putting their case forward. So it may not be the actual hike size that's important for them, but the discussions that went on behind it. And we get that from the meeting, and we get that from sources not long after. So the risk to me is how unanimous was a 50 hike, or how strong the doves fought against it, or the hawks had to fight to get it. That, I think, is going to move markets, because it's going to tell us the sway of the hawks versus the doves at the ECB, and that's going to determine policy going forward. And I think also for the Bank of England, that's going to be important, because we get the votes. Obviously, last time 6 of the 9 voted for the half-point hike, 2 wanted the rate left unchanged, and 1 wanted a 75. So really going to be looking at those 6. Are they going to step down their hike size? Are they going to move to unchanged? Is the 75 BP going to move down as well? Is it going to all sound a little bit less hawkish than the last meeting? And I think the risk for the Bank of England is that maybe they look to pause a bit sooner than the market expects, or conversely go a bit higher than the market expects. I think it's a bit two-way there. But I think in total risk terms,
So, sorry to interrupt. No, carry on. I just have something to say about the Bank of England.
Yeah, so I was just about to say, just to summarise, I think the bigger price risk is with the Fed, less price risk with the ECB, and moderate price risk for the Bank of England. But yeah, go ahead, mate.
No, I was just going to say not the previous meeting, the one before of the Bank of England, it was a unanimous vote. And now the previous one, we had 2 people voting for no change, which was a surprise. And given the big disparity, 1 voted for 75 and 2 voted for nothing. I think this meeting, the ultra hawks, and the hawks in general, seeing how inflation, okay, in the UK it's not dropping as quickly actually, but seeing how things are calming down in the Fed, and and the Fed is going to be stopping soon, and we all know the Fed leads the way. I think there's a bigger risk that the hawks kind of turn more neutral. I'm not saying we're going to see more than 2 voting for no change, but I think definitely no 75s, and maybe the 50s are going to go. I think they're going to do 50, that's for sure. But I think the guidance may be that it's going to be slowing down as well going forward.
Yeah, definitely.
And let's remember that the Bank of England always, at least for as long as I've traded, whenever they get a chance to be more dovish, they're more dovish. So
yeah, and as Kay likes to point out in the room, usually when Bailey speaks, the pound goes down. So he's trading guide for that one.
yeah.
Right, question from Surab. Would you recommend not trading dollar, euro, and pound until central bank meetings Wednesday and Thursday? But as mentioned, you can trade it. There's always a trade to be had, but it depends on your outlook, what you're trading, how you trade. If you're a scalper, then yeah, I think these are going to be maybe a perfect time to scalp. 10 to 15 pips, leaning on the decent levels, that sort of thing. If you're looking to take a longer term view, something past the central banks, then that's where you've got to be more careful. If you think euro's going to 110 for whatever reason, you need to know that the Fed aren't going to be more hawkish, or the ECB less hawkish than they're going to be. And if they are, or if they give any sort of unhawkishness or something that will send this lower or the opposite direction in which you think you're expecting, well, you've got a choice. You either wait for that to happen, and that gives you a better level to get in at, as opposed to just jumping in now and running that position over that risk event. I don't like running open positions over risk events unless they're part of a longer term strategy where that risk event is just short term noise and doesn't really change much of my strategy. But if you're thinking euro's going to 110 and you think, right, I'm going to buy it here, you're running that price risk and maybe seeing the price move down to 108 and knocking around there for a bit before the market does whatever it wants to do. So, if you're an inexperienced trader, you're not got a position, I would say, unless you're doing something really short term, picking off the levels for 5, 10, 15, 20 pips, it might be wise to sit on your hands. See if the market gives you what you want if you've got a view on it. And if it doesn't, if the market confirms what you thought, well, you can always get back in. Just because you don't buy the dip, if it happens and then it runs 200 pips, it doesn't matter. If you get the position right after the news, you still might get your run to 110. If it means you're buying it at 120, 109, 25, 30, so be it. If it goes to 110, you still made money. Always worry about making money or not losing money first, rather about was that trade 70 pips or 200 pips. Doesn't matter. Just put it in the bank, whatever you make. A win's a win, however it comes around. Horatio's asking about what's my opinion on pound Aussie shorts. Oh, we love a bit of pound Aussie here. Some of you guys love a bit of pound Aussie. What is it with the pound Aussie, you guys? You love a bit of pound Aussie. Right, well, as you can see from that chart, Horatio, I don't look at it that often. I probably should do, because you lot love looking at it now and again. We were actually speaking about this last week, because we did have you folks interested. We're still holding below this 75 handle, just about. We're not making a move and not holding back above it. So as we mentioned last week, I think it was, this is your key level. If you're going to see it move high, it's got to get back above 75 and hold it. And it's not doing it at the moment. That keeps the downside in play. But for now, we could be waiting for the Bank of England risk event. If they aren't as hawkish, or if they're a bit dovish, then, you've got the RBA, who's just seen a strong inflation print. They may be looking to not pause as quickly as they might have liked. That's going to see the Aussie gain. And then you've got a Bank of England potentially slowing more than expected. Well, there's one way that this one's going to go, and that's south, purely based on the divergence trade. And what we'll do is I'll stick a pin in this one, Horatio, because this is the sort of cross play that that we'll get into tomorrow, just on that basis to show you how crosses differ. You know, this has got nothing to do with the dollar, pound Kiwi, pound Aussie. So that's why this cross is important, to play those different central bank divergences, because there may be a bit more of a trade, a bit more movement in here than some of the majors on that one. One other instrument I'm keeping an eye on is oil. I had a little long on Friday. There we go. Let's go into that one now. Yeah, just Friday afternoon. I'm still not sure why I took the trade. Mainly because I wanted to catch a knife. I bought it at 80.15, I think it was. It's pretty much after the last lot of data, we got this move down here. Picked up 80.15, knocked a bit out 80.50s, and then I'm just waiting to see what happens here. I've got to stop at this price is different to what I've got. My pricing is a different pricing. I've got to stop at 78.80, which hasn't been triggered. So I'm seeing what happens here. This is something I'm going to watch for now. China's back open. There's two things going on. We've got the US refilling their SPR reserves. We had that back in December. They're buying Fed contracts. So we're going to see if that continues, whether they keep buying through this month into next month, and to see what happens with China. If China coming back online, that should be a bit of a boom for commodities. We know they're easing tensions with Australia on coal and things like that, you know, so imports are likely to pick up from those guys. And oil is another one. It's a bit of a global growth metric, if you like. You know, if oil's doing well, it means usually the global economy is doing well, stripping out all the OPEC messing around that they get up to at their various meetings. So I'm long still a bit up here. We have got a bit of a range on. This downside area 78, high 77s might be a bit of a trapdoor. If we break through that, then we might be heading down towards the mid 70s, maybe a bit lower. But what we have got is a bit of a solid line around this old fib at 82.50. That is the level we can't get above for the moment. So that's the top side marker for oil. Still, you got your eye on anything in particular for this week? You obviously said yields and stocks. Nothing else? You're going to be keeping a close eye on metals, or are metals just going to move around more so what the dollar's doing?
Yeah, pretty much, and the Fed. So, I mean, our friend asked, would you trade anything ahead of the FOMC? Of course. For me, one of the pretty clean ones is the euro dollar, and you have the 109.42. I think is the. Let me have a look. Hold on.
Yeah, you've got a fib up there. I think
it's a fib up there, yes, and also it's the previous highs from a few days ago. So it's been banging itself up above that level or thereabouts. Maybe it's got to about 10 pips from there. So for me, if you want to get short, that's a really nice area. 109.30. 30 to 40, I think it's a nice area. You know where you're wrong, and I would definitely not take it over the Fed, because it could jump, it could gap 20 pips or just or more, and then it becomes a nightmare. So I would say keep size small. There are trades that that I think one can take ahead of it. The one that I've been talking about over the last few days or sessions is the S&P. I do think we're going to squeeze into the Fed. So, where are we now? 40.34. I think, 4,100 to 4,150. I think we can get there ahead of the FOMC. Obviously, after the FOMC, all bets are off. Again, small size I would do. And I think I'm going to try another long in the S&P. Maybe if we get down to 40.13 again, which was the low from that candle. Yeah, I'm going to have a look at that. But I think I'm going to take a short-term trade, like a scalp for that, simply because I think we're going to see a little bit of a squeeze going forward, continuing. But other than that, I'm not really getting into anything. I still have my hard positioning in the silver long, which frustratingly is right in the middle of, I know it's a wide range that I've been talking about, 22 to 22.20 maybe, and 24.5. I mean, those are the two levels, and we're right in the middle, and we have been in the middle for ages. So unless that breaks either side, I'm not touching it. I'm just keeping my longs, which are nicely in the money, and I'm not in a hurry to do anything. I would obviously like the Fed to be dovish for that to perform better, but there's a chance that they won't be. So that's why I'm not going all guns blazing into it. But otherwise, you know, the other pair that I've been talking about, Euro Pound, we're at 88 now. I want to be a buyer on dips of that. So the 50 DMA is coming in at 87.35, I think, or somewhere around there. If we get a nice little dip into that, I definitely want to be buying that. But I think the target is 90. And I've been saying this for a while, and we've been getting there slowly but surely. So yeah, other than that, not that much really going on ahead of the Fed, and I don't want to take too much risk ahead of this event.
And it's also a margin thing as well. You know, talk about something like euro dollar. You know, if you're playing the range short term this week, you're selling up into this 109s, 30s, 40s area, looking for shorts. You know, if you find you're going into Wednesday morning and it's trading at 108.30, you've got a bit of movement there. You've got a bit of space to play it rather than just getting out. You know, you might be 60, 70 pips. You've taken some profit, you're sitting on a good trade, you don't want to give up a good trade. Well, you know, you've got some margin to play with. But if you're short at 109.30 and the price is 109.10 going into the Fed, you've not got any margin. So, you know, if you're leaving it on, really you're gambling, you're not trading. You're saying, well, I'm 10 pips okay, I'm going to let it ride, see what happens. You may be right, you may be wrong. It's a coin toss. And you know, if that's your risk parameters, fine, go ahead with it. It's not mine. It's not Stell's. I very much doubt it's K-Man's. So if I'm got something like that, I'll say fine. I'm 10 pips in profit. I'll take it off the table. Worry about it after. New trade, new opportunity. But if you have got margin in a trade, then work with it. You know, don't like giving up a good trade, definitely. But you need to have some money in the bank as well.
Wise words, my friend.
Thank you very much, my friend. And you'll give me around tomorrow if we start digging about the crosses and stuff and the divergences. I mean, you know, you must have done something similar in your line of work where it's not all about the dollar, is it? And you have to look at the other side of the coin. So I hope you'll have some wise words for us tomorrow.
I will be there. I will be there for sure.
And if you haven't, you've got until tomorrow to do some swatting up.
Yeah.
So anyway, yeah, we'll call it a day there for today. Thank you very much, boys and girls. Get yourself set up this week. Lots to be done, lots to come out, lots of data, lots of news, lots of price moves, I'm sure. So make sure you are ready. Do your homework. And we shall see you all bright and breezy tomorrow. Thank you very much, everybody. Thanks, Dale.
Thank you, Ryan, and everybody. Thank you.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.